Good evening, ladies and gentlemen. This is Clueless Ape Trading Frank. It's approximately 8:10 p.m. Eastern Standard Time here on the East Coast. It is December 30th, 2018. This session is being recorded and can be viewed by anyone with the internet connection on the Google Clueless Ape Trading Google YouTube channel. Quick thing, just a chain of thought here. Sorry about that. A bunch of things going on. Tonight's session is going to be a very direct, very technical. We're not going to go into long-winded explanations, but it should be extremely helpful for the coming days going into the new year. Saying all that, I welcome everyone here. We have some old friends here, and let me begin. First and foremost, let me just make a very straight point here. This is a absolutely wild market. No question about it. But one of the key things that I want people to concentrate on, it's called demystifying this sudden, rapid, extremely fast programs that run the market, which I've been talking about for years now, but now they seem to have taken full control, which are basically the algorithmic high-frequency trading black boxes. There's no way around it. There's no way around it. You hear a lot of the big shots give different reasons for it: lack of liquidity, the risk factors that are prevalent in the market in the form of news flashes, presidential tweets, comments coming out of central banks, including ours, which can be sometimes misconstrued, misspoken, whatever the case may be, without getting too much into the nitty-gritty of it. The fact is the markets react instantaneously. Now, for a lot of people who really don't quite fully understand the market, to them, this type of stuff is absolutely nuts. The level of activity in the market by traders and investors have ground to a halt, pretty much. I see that within our member group too. People get extremely dejected. From a human perspective, that's fully understandable. There's no question about it. And they feel that they have no control of what's going on. They have fantastic charts they're working with, and within a flash second, it goes the other way, without even sometimes giving time to react, because no one can move as fast as the machines. But there are some, there's some workaround solutions around it, and we're going to talk about that. So the level of despair, the level of bullishness or investor sentiment in the market has come down to some of the lowest levels not seen since 2008, 2009. I don't need to remind anyone, well, maybe some people who haven't been in the market, that 2008, 2009 felt for outside market participants that it was, and even for Wall Street participants, it felt like it was the Great Depression and more. And everyone fled the market, everyone. And the markets over time went up on a solid move higher. And in between every 1 to 2 years, we got big corrections. So this correction that we're seeing, and I'm going to put an article out there so you can see historically that this is not one of the largest corrections. Or pullbacks. What this is the speed and ferocity of the move. It's unprecedented. But then it's a law of numbers. If the Dow was at 10,000 and fell 5%, that's a drop of 500 points. When the Dow is at 20,000 and it falls 5%, that's a drop of 1,000 points. It's just a law of numbers. It's just like buying a $2 stock, it goes to 3. No one really gets excited about it. It's like, but it's up 50%. But if it's a $2,000 stock, goes to 3,000, they're like, wow, that's unbelievable. Look at that. It's still 50%. So it's the law of numbers, and basically it's the sort of the trick of the law of large numbers, basically. So the law of small numbers, just like everything in life, doesn't really have much credence anymore. I mean, it doesn't have the same impact in your brain than if it's a large number. So we're at a large number. President Trump comes in November 16th. We take off like a rocket. We pull back, then we really take off. And then in 2017, we hit some big highs. to 2018. In between, there's a lot of volatility going on, mind you. So the numbers as they went higher, and I can't even remember what it went to, what the Dow went to. What did it go to? 27,000 and change, right? And we basically dropped straight down for 4 to 5,000 points, just like that. Boom. Okay. And these small charts we're going to go through, this is where we were. So we basically, between the months of October and November, if you just want to look at it in a very simplistic way, we just dropped this. Huge. Now, in between, there were huge rallies. Different patterns. Everything was explained, guided through. We made some very powerful forecasts. Most of them were right on the ball. And then we were expecting a move up from the 50 fib, and then this happened. Now, this lasted a couple of days, and this was basically a huge, massive, can't even say it, huge. I mean, it was beyond huge. It was a monstrous liquidation. Some fund out there, whether it's a sovereign fund, which means a country fund run by, one of the sovereign nations, or whether it's some big hedge funds, somebody liquidated. And that caused a cascade of waterfall declines. And every time the market moved up, 400, 500, 600 points, it got slammed. So in between, there are trading opportunities, no question about it. But you have to be on your toes, and you got to be quick, and there's no easy way around it. So the third broad point, second major broad point I want to basically make is, and this is probably going to, this is going to be the last webinar of 2018, is the market from a trading perspective and even from an investment perspective has fundamentally changed. And there's nothing good or bad about it. It's just changed. We know what the risks are. We know risks of the Fed going on a rate hike binge, which I don't think they will. The risks of a escalating full escalation of the China trade war, which is certainly not happening. President Trump is doing a terrific job. Look at the headlines over the weekend. It's a long talk with Xi. You don't talk to President Xi of China, who's a tough nut to start with, and for an hour or 2 hours just to basically call names. You can do that on Twitter. So you're having conversations with and I don't consider China an enemy. In my book, it's an economic counterpart. That's it's an economic competitor. That's what they are. And they got a lot of stuff that they need to fix, and they're starting to do that. It doesn't happen in one day. We sold, if you guys remember, just a couple of years ago, every company, just even last year, every company who had the most humongous earnings, what was the big thing? They entered China. Because China is the frigging 2 billion people. I don't know, like 1/4 of the world's population. And they're consuming things. So you can't just write off something and say, whether it be soybeans, whether it be technology, whether it be cars, whether it be other stuff, what we are good at, which is specialized materials, aircraft, defense, the high-end stuff, technology, pioneers of so many things. You just can't say, okay, we're not going to sell into China, see you later. It doesn't work like that. And just a year or 2 years ago or 3 years ago, companies flourished because their markets, we went in hard, and they love Americans. I talk to the average Chinese in China. What do you think? I really hate Americans. They love Americans. Who doesn't? They love American goods. Who doesn't? I think Americans like American goods less than, what foreigners do. Believe me, I know. Okay? So the key is that, So the key is that somehow or the other, we have to economically and militarily coexist too. China's not going to invade us. They're going to try to push they're trying to be a first world country. So they're going to push into parts of the world using their economic power and their political power to take advantage. Take advantage of a lot of different parts of the world. Didn't we do that? We do that all the time. But let's face facts. Let's not going to be hypocrites about this here, okay? What they're doing is what we did for the last 50, 60, 70 years. We dominated because we had the best goods. We had the best people going out there. We built nations like Japan after we bombed the crap out of them, not making light of what happened there. And then they love us. That's just the way it goes. So you can't just write off a whole, and it's not a nation. This is 1/4 of the world's population, and say, okay, we won't do business with you. So the pressure that President Trump is putting through, in my opinion, is working. It's a very, it's tricky. It's very tricky. There's no question about it, because the different members of the team, some are just complete China haters, like Navarro, and he has a right to his opinion. And then there are the more practical guys in there, like Ambassador Lighthizer and Mnuchin and all these other people who are more on an engagement politics. Remember, Golda Meir, one of the founders of Israel, said, you talk to your enemies. You negotiate with your enemies, not with your friends, right? So if China's an economic enemy, because we are competing on so many different fronts, and we're far superior than them in so many other ways when it comes to technology and other stuff, then you have to engage. You just can't stop talking. It doesn't work like that. Okay, enough of that. So the key thing is we already know the risks. So at this point, the plus points. The plus points are the China trade talks are moving along very well, in my opinion. In between, you're going to hear the Navarro type of comment saying, I hate everything. I hate, I can't stand Peking duck, and I hate dumplings. And, he's going to come on and say some stuff. He's a very angry guy. Let's just put it this way. He's a very smart guy, Peter Navarro. I think, where does he teach? UC Berkeley? I can't remember. In California, he's a professor. But he's always been a China hawk. And that's fine. You need that. I think that's a plus. The Fed is fine. Doesn't matter. Powell is a complete nerd. I explained that in my previous. I believe I explained that in my previous thing. He doesn't know how to talk. He really doesn't. And he made a major mistake by saying that everything should be, or the whole balance sheet reduction. Don't want to get into that stuff. Is going to be on autopilot. The market's like, what? And we went up big, and then we just, collapsed for the next week. It's all manipulated. It's in one comment. It's on autopilot. Jerome Powell is not in the business of destroying America. Okay. Period. So, but his comment was moderated. The next thing you had other governors coming in and clarifying the statement and saying, no, depending on data, we're going to moderate our stance on raising rates. It's the way it is. Every single Fed chairman has been criticized. I can remember how much they just went after Bernanke. He did a fine job. Keep politics aside. These people are very smart people. Okay? They said, oh my God, he's flushing the U.S. economy with money. Look at the debt. Look at our debt now. I support President Trump's business policies to the hill. You guys know that. I think he's doing, I think his policies are perfect on the business side and all that. And he wants to pump up the debt more. So at one point, that's going to come back to bite if we don't control it. That's why Fed Powell wants to raise rates a little bit, have room just in case things go completely wrong, and reduce the balance sheet so the debt doesn't go completely nuts. So remember a couple of years ago, there's a Bernanke, oh my God, he's just, just pumping the U.S. economy, just going to completely collapse. Everyone in life is a hypocrite. Look, we're all older, okay? And people have a natural tendency to be hypocrites, all right? They all forget, 1 minute that's good, the next minute that's great. Come on, cut it out, all right? It's not anything good or bad. It's how you manage it. So you have Bernanke, and then you have Janet Powell. Janet Yellen, oh my God, she got so much heat. Oh, she doesn't raise rates. Santelli's screaming his lungs out. So now Powell's raising rates. He's raised a couple of times because you need to do that. So what's the real big deal here? We're all just going to collapse and die because he's raising rates a bit? And he's probably going to not raise rates at all in 2019 if things is as rocky as it is, and the housing market really starts to slow down, which is a huge pillar of the U.S. economy. He's going to back off. And what? He should cut rates? Come on. If he doesn't raise rates, if he didn't raise rates and he cut rates, the market would be down 10,000 points. That means something is really wrong. Okay, so enough of the hypocrisy. Leave this. The Fed guys are okay. They just need to. But they need to be a little bit more in touch with things, and they are. But they're like a bunch of nerds who basically just go by the scripted book and nothing else is right. That's how he sounded. But his actions will prove that that is not how he is. And if he is, the markets have already sent a message, big message, by dropping thousands of points that you don't do that type of thing. And his lieutenants have come out, the other governors, and they've sorted it out. So we're okay with that. The other risk, and I have to make these broad points, the other real risk is earnings risk. We're coming into first quarter. The fourth quarter numbers are going to be coming up starting mid-January. If we start to see a real deceleration, talk of the fact how much U.S. corporations, and you know my feelings about the fact that you don't mess around with U.S. business. Let them be. Let them be. We're not socialists. We're not communists. We don't tell you private businesses what to do. We can make a comment or two, but we don't need to go after them. I don't like what President Trump does when he does that. I think it's wrong. That's what Stalin did. That's what Lenin does. That's what Mao Zedong did. And you want to be associated with those dictators? I don't think so. Especially when it comes to the business side. Yeah, you can make a comment or two, but you don't go after them. Go by the jugular. You don't. Because private business is private business. It's not government business. We're not in the business of big government. So if we're not in the business of big government, what the heck are we doing poking our fingers in the eyes of the finest U.S. corporations in the world? You can make a comment or two, but you don't need to attack them on Twitter. You don't need to castigate them. Because U.S. business is what made America great. Nothing else. Nothing else. Right? Simple. It's really simple. Keep politics aside. So, saying all that, the other big risk is that if large companies start to warn what going forward, that they are seeing a sharp deceleration on their bottom line earnings because of this tariff, which have already been put in place on a whole bunch of goods. We know that. That's the reason why the market's here. Otherwise, the markets would be way here, back in that channel. All right? The Dow Jones would be at 27, 28, 29,000 instead of here. So that is a huge risk. If we start to see earnings risk, you're going to see this market crack. And it's going to crack more. So at one point, the market is short term. The market is pretty goddamn cheap right now on any valuation basis, because what the correction, the pullback did was it basically said that there's going to be zero earnings growth overall for S&P 500 companies and other companies in 2019. Somebody may say that's really hard to believe. Look at the way they're treating Apple, like as if they're just gone out of business. iPhone sales, they didn't make they slowed on the high end stuff. But what about their lower end stuff? We don't even have those numbers yet, because Apple changed their policy. They're not going to release numbers every single month on their sales. Come on. Apple's service business, which is a much bigger part of their business, and not much bigger part, but the fastest growing part of the business, Apple apps and services and so many other things they're doing, has not even been taken into account. But you listen to these analysts in Apple, oh God, it's just like they are finished. Okay, great. They said that about Apple how many times in the past 10 years? But it's a law of large numbers. It's a very large company, so for them to grow 5%, 6%, 10%, it requires a lot of push. You cut out China of the picture if things at one point were really getting hairy, remember? And from President Trump was basically, oh, we're maybe put some nice tariffs on Apple products that are made in China. Okay, that's great. Cut out the global supply chain. Okay, you bring all the jobs back here. Your Apple iPhone will cost triple the price. That's just the way it works. The basic stuff, the assembly part, is what's done in China. The heavy part, all the technology part, is made in the USA. You get a guy from here, I don't care who it is, and say, listen, you're out of a job, you're sitting on welfare, I want you to assemble Apple phones for $7 an hour. You tell me he's going to go do it, I'll bring every job back to the U.S. He'd be like, oh, no, thank you, I'm getting my check coming in next week. That's the reality of life, guys. You can deny it as much as you want. Okay? Remember, just waving a flag and just screaming and shouting doesn't make America great. What makes America great is making pinpointed where we bring in the money, we still conduct business, we don't let other people take advantage of us, and those are the things that President Trump is doing a terrific job of fixing with China. But you don't just lock, stock, and barrel say, okay, that's it, we're bringing all these things back. Great, okay. So you're going to see if we start to see a big hit in earnings, or warnings, I should say, of slowing earnings from the large companies, FedEx and FedEx guy is like as all American as you can get, right? Forget the name, the CEO. He just said it straight out. I mean, that's a real, patriot. And he said it the way he saw it. Didn't like the way things were going. And FedEx stock collapsed on their earnings last week. All right. So, and he's not a partisan guy, He's not some real left wing Elizabeth Warren type of Democrat. He's from the Midwest, hardcore, all American. Forget his name. It's a great CEO. So if you start to hear things like that, it's not going to work. So it's going to be 2019 is going to be is at least broader picture will be a difficult year. What's other risk? There's always some risk that's going to come. Let's talk about the good things. The China talks are going well. Congratulations, President Trump. He's doing a good job on that. Let's continue with that. Not disengage and say, no, we're not going to speak to them anymore. That's it. You'll see you later. You know what the market does. That's a positive. Number two, the Italian circus is over for now. The Italian government, the five-party or whatever they call it, five-star party, they have successfully negotiated the budget stuff with the EU, and that was over the weekend on Saturday, so that worked out. Remember, Italy financial fears can drive European markets lower. That hits our shores, and we've seen that happen before, so that worked out fine. We have had a huge correction where things have gotten pretty cheap. Things have gotten pretty cheap. So that's a plus. That's a plus. And of course, overall, okay. And this government shutdown thing back and forth, which is pure politics, that needs to be resolved. If the government wasn't shut down right now, we would be up 700 points or 1,000 points from where we are right now. But that's just the reality of things. So I'm sure they're going to hammer it out. They're going to hammer it out because the government can't endlessly stay shut down. It doesn't help anybody. So they're going to work it out. There's a lot of things going on underneath the surface, and they're talking, and they're going to basically, they're going to get the money. They're going to change the lingo and stuff like that. That's, just the way the what do you call the horse trading works in DC. That never changes. So now, coming back to the reality of what we do. What we try to do here is we try to decipher this absolute random, what people think is random craziness in the market through charts. And for anybody who doesn't still by now understand or want to trade charts or look at them and just think that if you just sit there forever, it's just going to work out fine, they're going to be massively disappointed. This is 110%, not 100%, 110% algorithmic high-frequency trading, black box-driven mechanical market. That's it. While those guys try to scratch their head and like, oh my God, what the market's going to do, look at that. We are demystifying the movements in the market and forecasting. Forecasting in this type of environment, you guys got to understand, is absolutely horrendously difficult. But it is not that difficult. When I put out my tactical charts, and we're going to start off with the 15-minute version. This is the 1-hour version. This is the 15-minute version, right? Okay. And we're going to basically zoom out to the 1 hour. We're going to zoom out to the daily. We're going to zoom out to the weekly. We're going to zoom out to the monthly, and we're going to stop. And trust me, these are very accurate charts, but things are happening very fast. And but when we get extreme situations, that's the time to basically bite into. It's when we get to these levels where we start getting those range trading moves, and we want the range to break out because we're mostly on the long side. We do intraday shorts, but it doesn't break out. It just kind of chops around. So that's really what's happening right now. So, but the only way you can demystify this craziness and not go completely crazy is number one, got to keep your trade smaller. You have to move faster. You don't need to don't need to get super excited by 1,000-point move, which we got. The pension fund rebalance. You don't need to get completely saddened and you want to just slit your wrist, or whatever, because we are down 1,000 points. Because in a flash of an eye, depending on the charts, it's going to go the other way. I don't want to get too analytical, but let me walk through the charts here. I have to help my wife with something really important tonight, and I actually wanted to just do it. I actually was going to do this tomorrow, then I realized tomorrow is 31st, and I'm glad that I get to see some friends here, good people. So let me get through this. First of all, when we crashed and burned and we went down to 2,300, okay, this is the E-minis we're talking about. I said, I drew this chart, showed it out to you guys, and I said we're going to at least get to the 50% Fibonacci retracement level. Well, it got there. It was the Christmas Eve massacre. That's what they call it. What happened to the market? Down 625 points. This move here on Christmas Eve, in my opinion, was a completely fake, manipulated, and a direct attack on making, I truly believe this, on, for whatever reason, making the Trump administration look bad. Because when you read the history books, on December 24th, on Christmas Eve, the holiest days of the year, joyous days of the year, the market was down 620 some points. That can be rewritten out of the history books, and it was under President Trump. So somewhere out there, somebody just basically ambushed the market. You can call it, oh, there was this pension, there's some fund had to liquidate, whatever it is. There was absolutely no reason for this drop on the 24th, which was a half a day, when the markets were up nicely the first part of the day, and then the collapse started. This, in my opinion, it's certainly a coordinated attack, an ambush on U.S. financial markets to make the Trump administration and its business policies look bad. End of story. That's my opinion. Saying all that, what happened? We took some moderate positions. Christmas Day passed. 26th, the markets gapped open. Then we took off. On the 26th, that was the day, right? We went up 1,000 points. So even if you stepped in different parts of the move, of the day, you could have still made some money. You don't get 1,000-point moves in the market, but then this is a very different type of market. We have had 1,000-point drops almost. So we have had 1,200-point swings during the day. So expect the unexpected. This is the new normal. So the fact that the market went up 1,000 points is nothing to be completely super elated about, but it is stunning for whatever reason. So saying all that, we gave back half of that. Everyone's freaking out again. All it did was basically come back and retest this fat green dotted line, which is the Fib 50, Fibonacci 50% level. Extreme sell-off, one with other, it got to the Fib 50. So somebody says, well, how do I know? You hear these traders say, how do you know? Look, I don't need to know. I'm trying to decipher the charts and be a messenger faster than other people. That's all. Am I not losing money here and there? Absolutely I am. Am I trying to take up opportunity of these massive moves coming off these climactic bottoms? Absolutely I am. Am I offering you guys a demystified version of the market through these very precise tactical charts? Each level engaged? Absolutely I am. I'm doing this regardless of the fact that we have had such a large emotional loss in our family, our little puppy mill rescue, which was just, it wasn't just a pup dog. It was something that was dying when we got him from the shelter, North Shore Animal League, and it turned into this absolute bundle of spirit and joy and love. And then all of a sudden, in 48 hours, the light was extinguished. Okay? So through all this, every single day, these charts are being delivered. Every half an hour, every 15 minutes, every hour, and alerts are delivered, and people can do what they need to do. So just want to make a point of that. These are very trying times for a lot of people. It's a very difficult market to trade, but if you focus on the charts and look at these levels and stuff, you can still make some pretty decent money, because the reality of the situation is that these type of moves do not occur in a bull market. These type of moves coming off these extreme bottoms, absolute pattern symmetry. You can see that, and I've showed that repeatedly on my charts. Crossing over the 50, going to up to retesting the breakdown level right here, and then taking off. This large spurt that occurred around 2 o'clock of 200 or 300 more points was primarily because the shorts who kept on shorting at this level here at 24.27 realized, oh Lord, they're going to push this higher. So this is what you call the pop, or the last leg of the short squeeze. And that's exactly what happened. So saying all that, charts are pretty easy to read. Fibonacci retracement, anytime you get these extreme sell-off, it is going to have a 50% retracement. That's exactly what it did. And once it got to the 50%, what did it do? There was a volatility cluster, back and forth, 60, 70, 80 points, back and forth, back and forth. And then as it developed, once it broke out, it goes. Then we came down, and it looks like all was lost, right? On the 27th, it comes down, retest the 50, retest the breakout of this bear flag. Remember, this is a bear flag. That's a bear flag. It retests the bear flag and retests the 50 and goes berserk. Don't expect these type of berserk 500-point up moves here and there, but hey, it happens. So I'm not here to make the rules. Things have changed. So saying all that, this is a great tactical chart for intraday traders primarily. And then you can zoom back and see, you can basically see what happened a couple of days ago. But this is primarily for people who are trying to trade during the day, close out their positions at the end of the day, or at least have an idea what they might want to do for the next day. But this is not a long, intermediate term swing chart. This is a short term chart, very precise. You can work it. So let's move on to the next one. The next one zooms out a little bit more, and it is the 1 hour chart. The 1 hour charts give you a much broader view. I called this before it happened. Little did I know that this was going to happen like that, but that lasted just one day. That was the 23rd and the 24th Christmas Eve massacre of the financial markets. We just talked about it. So that was capitulation, final wave. I mean, at that point, stocks are toxic for the average person out there. You can hear all the talking heads are basically just, oh my God, we're definitely going into recession. That's another topic I didn't want to cover. We'll cover that in the new year. Oh, the U.S. economy is definitely going into recession. Okay, great. Last you checked, if you remember, 9 out of like they have predicted more recessions than actually you have had. There's a joke saying that economists predicts 8 recessions out of the 6 that happened. I mean, those guys are just. I mean, the only way we have a real recession is if things just fall apart and we go into a full-scale trade war, impacts our housing industry, consumers back off. We have a recession. No question about it. Is it a possibility? Sure. But sitting here saying the inverted yield curve, we talked about that in one of the webinars, and the fact that, government spending going way higher, a deficit ballooning, or the Fed going bonkers, is not, it doesn't give you any concrete evidence there's going to be a recession. None of the companies have said that everything's slowing down to the point we're going to get a recession. Consumers are still strong. They're still going out there. You start to get into a massive tariff fight, and prices of goods actually start moving up really high. You walk into a Walmart, a Costco, their supply chains make a lot of the basic stuff in China. Everything's costing 30, 40% more. Nobody's buying. That's when we have a recession. Okay? So unless everyone wants to take a wage cut, right? Everyone said, okay, I'm not going to make $20 working in that factory. I'll just for the sake of fighting the Chinese, I'm going to take a haircut. I'll just make $10. No problem, no problem. Yeah, right. Just to keep the prices of goods down. It doesn't work like that. So bottom line is, we don't have whiffs of any real recession. There's a lot of talk about it, right? So this was the final wave 5. Stocks are toxic. No one wants to touch anything, and obviously a massive buying opportunity. This is where we are right now. And if you're trading charts, you don't even need to know all this other stuff, the noise that goes on out there. A lot of the noise is real. If you just, let's imagine you cut yourself off completely and you just said, that's it, I'm sticking to Clueless trading charts, I have my own charts, and that's the only thing I'm going to ever look at. Well, you're going to be doing pretty well because the charts are pretty clear. I try to put as many arrows as possible, but it's not physically impossible. I mean, humanly possible for me to put tons and tons of arrows. In that case, my whole frigging chart will look like one big arrow. So I try to show the big inflection points. But by now, and that's the theme of 2019, I said that a couple of times, it's time to grow up. It's time to grow up and take personal responsibility for your own trading, for your own investing. I try to handhold as much as possible through my charts, but it's just not possible for me to put like 900 different arrows. Everyone should know that this is a resistance level. A red line is a support level. This is a fat red line. That means that we don't want it to really go below that. That's a major support level. This is a major support level. This is an uptrending channel. This is a downtrend. This is a downtrend channel right there. This is a downtrend line. This is an uptrend line. This is a stochastic. When it gets overbought, things start to ease back. When it gets oversold, better chances that it's going to jump from there. These basic things you have to know. 2019, time to grow up. We lost a few members over the past couple of weeks for no other reason other than the fact that, in my opinion, they're smart people, they're good people, but stubborn enough not to understand the basics of these precision charts that are delivered every single day. They're waiting for some nirvana about the market, that the market's going to be a beautiful place, and like a walk in the park on a beautiful Sunday afternoon. It's never going to be like that, guys. I hate to say it, but it won't. The market will become as treacherous as possible, and the rewards will be when you attack the viciousness of the market by not just buying cheap. Cheap can get cheaper, but by buying these tactical levels that I constantly keep on showing. Futures are up right now, $13, $14, $15. 15 handles. Let's see where they end up tomorrow morning. I don't believe anything anymore. But actually it'll be fine because a lot of the Asian markets are closed today. But there's a lot of positive news. The fact that President Trump took the time and spoke to President Xi, how much more positive can it get? That's amazing. The fact that the Italian the circus clowns basically worked it out with the EU, that's great. And I love Italy. So, but their politics, it's a total mess all the time. It still runs. They still make the finest things in the world. Isn't that amazing? So bottom line is that stick to the charts. Stick to the charts. Grow up. Take responsibility. Stop freaking out every time the market's down 50, 100 points. It is not going to be a feel-good market. It is going to be a feel-the-profits market if you do it right. You will get hit. You will get hit. There's no way around it because the markets move too fast. I left because I had to deal with something very important at 3 o'clock on Friday. Right after I left, I checked my phone about 20 minutes later when we got there, and the markets were down 70 points. When I left, they were up 240 points. So they must have been like, oh my God, this is crazy. Look at that. The market just fell. You know what? It's a very treacherous market. There are big liquidation programs going on. There are big buy programs going on. It's just very hard to fathom. Even the big shots who work on the floor can't figure out where those programs are coming from. And this red candle, does it mean it's the end of the world? No. It simply came back and retested this ascending triangle right there. That is an ascending triangle. We broke out of it beautifully on the 27th, went up, knocked heads at this large supply point. I have an arrow there, which I call the pattern symmetry number 2, because this is pattern symmetry number 3. In other words, the completion part, the first leg of the major completion. Look how symmetrical these things are. And they went out over the ascending triangle. Nice little move. And I'm showing you the simplest charts here, not the complicated quad algo HFT version, not the toss versions. I'm just showing you the ones you can literally just trade off the lines that I'm drawing. That's it. And then it hit that, and there was one sell program. Took the market down 300 points, right? Okay. So instead of completely freaking out, look what it did technically. Technically, it did nothing wrong. Now, I could be eating my words tomorrow morning if we're down 400 points, but that's life. I don't think so. So basically, if you really look at this, there was absolutely nothing wrong that happened. What would have wrong, which would not have felt good, is if this red expansion candle, the sell candle that came in around 315, basically broke below. And broke below the 2441 mark. Then the whole structure, this is how you got to think when you go into 2019. And I know some of my members, including what you call, yeah, you're dead right, Fishy. Yeah, it is the Soros and his group. So basically, we're talking about George Soros. He is a complete U.S. hater, and he's been liquidating a bunch of his funds. He attacks the U.S. markets completely on a short basis. He talks a lot of garbage. He carries a lot of power. And I don't like George Soros. You guys know that. Not that he's not a brilliant person, but he is. He just does some very bad stuff and badmouths the U.S. markets and shorts so heavily at certain times when it's not necessary, that the pressure of those type of European large-scale George Soros type of shorts mixed in with our dogmatic shorts who always think that we are never going to go higher. You know, we have resident U.S. Dogmatic bears, grizzlies, who all the time, like, that's it, we can never go up. You mix in that, so it's kind of, it accelerates the downside. Yes. So anyway, so saying all that, basically what it would trick in the structure. So 2019 should be the year of understanding patterns and structure for all my members. I'm still adapting to the rapid movements of the market and training my brain and my eye to look at it and trying to find patterns in between this 600-700 point moves up and down. Okay, and you can see that there's a pattern. So it's uptrend channel. If we break below this, then we could very well come back and test the 2400 again. It could be like this. So at this point, you're completely free. So you have a little loose cash on the side. You basically get in at 2400. Because what we did was we went from 2300. Remember, I said this a long time. S&P 500 moves in 100-point increments. 100 times 6 or 7 means 600 to 700 points in the Dow. Those are the stages of the move. And look how correct that is. If you just want to look at it from a simplistic term, something hasn't changed. We went to about 2300. Then we went to 2400, right? So that's 100 S&P points, roughly 600 to 700 Dow points. And then we went to, one second. This is 2393. This is 2313. Yeah. So basically we went here. 100 points, 100 points. So once it hit that, went past 2580, I said 2530, I kept on saying, was where we could possibly get to. But before that, we had to tackle this zone here, which is a major supply zone, right? This is where the big selling came in. So we have to take care of that. But once we take care of that, you're going to get this. We might get that tomorrow. Okay? Just like that. Exact pattern reversal of this move here. We might get that tomorrow. Believe me when I tell you. Because, like they say in life, right? Expect less. And that way your expectations are not that high. So I'm not saying that's going to happen, but if it happens, believe me, it'll be simply, it'll complete this intermediate pattern. So that's it. So 100 points, 100-point moves. So we went from 2300 to 2400, which is roughly 2500 in a matter of days since Christmas Day, day after Christmas. So that's roughly about 12 to 1300 points on the, or 1400 points on the Dow Jones Industrial Average. So without spending any more time on this one, this is more of your swing chart. You see where we are, very clear. We broke out of this very large downtrend channel. And then the last sell program came in. Is it the last one? I have no freaking idea. That's like the stupidest question to ask. Like you know, some members, and you know, I'm not pointing any fingers, you know, and one of them recently canceled. His favorite question was, well, what do you think exactly is going to happen right now? I said, just look at my charts. I can give you a probability move of what might happen, but if you're asking me what's my opinion right now, well, in that case, let me control the Donald's phone, okay? And let me control what Navarro is going to say. Let me control what some China minister is going to say against the U.S. Let me control what the Federal Reserve microphone, and I'll tell you exactly where the markets are going to go. 2019 should be the year of being grown up, not asking just childish questions about, hey, mommy, are we getting there? You're no longer a child anymore. It's time to get rid of the diapers. It's time to put on the pants. Seriously. I would love to. My charts have been right overall. Overall, my charts have been dead right. But along the way, there have been lots of twists and turns. That's the way it is. So if somebody asks me, well, what's your opinion of the market right now? I can look at my charts. I can analyze what's going on out there and give you a probabilistic answer, but not a 100% certain answer, because that's what some people are looking for. So if you're looking for complete certainty in trading, it's never worked. And this year coming up, it's not going to work at all. There is a high element of risk. Therein lies the rewards. Let's move on. So this is your swing chart. You see what we're doing here. The next move could be another 100 points. So we did 2,500, we did 2,400, 2,300. We could do 2,600, and guess what? The 2,600 happens to be, lo and behold, magic. Happens to be this pattern completion. When that happened on the 19th, 2 o'clock on the 19th of December, a lot of people were caught. There are no people anymore, but even funds got caught. So this pattern, in my opinion, is going to happen by the first week of January. That's just my opinion, based on my charts. When I've said that before, it's happened. So get ready for that. Now, once you get up there, you don't want to get super excited because nobody bought this. The few members who cancel, they don't want to. They'll be coming in, creeping in like it's happened every single year. When we are up here, when we're breaking through 2,800, which will be the time, the fatal death knell, when the markets will drop another 2,000 points. Because by the time I said you feel comfortable, you feel good, that's the time they're going to ambush you. You want to buy when it feels the worst. You look at those charts, you look at those stows, you have to internally, one part of your brain is to get super excited. Say, that's it. That's what I'm getting in. I'm going to grit my teeth and I'm going to sit there, and over the next 4 days, Netflix is going to up 30 points. And yes, during the day, it could be up 5, down 15. But trade management, that's another story. But when those weak, there's nothing wrong with being weak. Because when you're weak, the only thing you can do is get strong. When you're strong, you can actually get weak. But when you're weak, you can work towards being strong. So those weak members, and of course the rest of the investor crowd out there, feel good about the markets. We're basically at that point, you want to be sellers or shorters. This was the perfect moment shown through this hammer. This is in the middle. This is going to be the first level of a major sell-off around the 2,600 level. Maybe not, but high probability says yes. So the best the market has from here, which is exciting, is 600-700 points. Take that. They keep on saying the bull market's dead. Okay, bull market's dead. I agree. All right, let's say bull market's dead. They've been saying this since 2009. So good. So why can't we trade these big moves? 1,400, 2,000 point moves. Do you really need to have a bull market to make money? No, you need ranges. You need some sort of pattern. Let's move on to the next chart. This is the same chart, and this has a lot more lines on it, but you can clearly see what's going on. When you quickly look at this chart, you have an idea. This one is showing you something else. This is showing you overall. That's the first thing that you catch your eye. Is that we're going to get up, we're going to jostle around, that the actual pattern completion is more around 2,750. Does everyone see that? Like if you just had 3 seconds to look at this chart, at least in my eye, this is what it looks like. Looks like when the breakdown really started was here, which we already know. So the market has a good shot to get further out the road. Can't give you time frames. Maybe around, let's say, after the initial move to 2,600, a pullback, and then the move to 2,750. This looks like more of the real pattern completion, because going above that, going into the 2,800s, that'll take a lot of effort. But does everyone see what I'm talking about? Here's your first pattern completion right there. You can see that very clearly. Then this move here, which can be replicated. This will happen, in my opinion, remember, we are sending a delegation to China, as if they're not there. Sure, they're there. We've always been talking to the Chinese. So, but the official so-called delegation with the cameras and stuff, right? Sometime in January. I think January 25th or so, or third week in January. Government shutdown works out. Government reopens. We get a couple of good earnings initially, and the market goes to 2,750. Then boom, something else will happen. Trust me, that's just the way it is. Markets are going to get nervous about the next Federal Reserve rate hike or non-rate hike. So this is the pattern we're looking at. I think Romeo agrees with me. That's our other doggy. Hold on one second. I'm going to let him out of the room. Okay. Can everyone hear me? Yes?
Yeah, we're still here.
Okay, sounds good. So that's the wider pattern we're looking at. Now, when happens, I have no idea, but it's going to happen within the next 6 to 8 weeks, if it happens. But that's a good probability for a pattern completion standpoint. You can see that pretty clearly. So position your mind that way, that we can possibly go to 2,700. Now, going back to this chart from all the way back, remember, we don't construct charts after the fact. We construct charts before the fact. So this was the all-time high in the mid 2900s, and this is where we are right now. So getting back to at least 2,600 almost mandatory for the markets. Why? Because that's the level roughly where we started the year. So right around here. This is your large downtrend channel. You don't need to listen to some, you don't need to like scratch your head and pay some other service hundreds of dollars and listen to all these big services telling you like, oh my God, this is doomsday and the U.S. economy is finished and, Trump is going to be impeached and blah, 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 blah. No, just have to follow the charts. This is your first pattern recognition. Cut out the noise. Okay? Barring any real black swan event, a real unquantifiable risk. We have already gone through lots of major, hardcore risks in the market. We know that. But barring any unquantifiable, unknown risk, aside from the ones that we already know, we are going to hit 2,600 and we are going to hit 2,750. So if somebody says, well, how do I play it? Well, one thing you can do, instead of dealing with this zigzag every single day, you might want to buy something a month out. Don't go too far out because things happen pretty fast. And add to it if it stays within the channel. That's the way to do it. If it stays within the uptrend line and the structure remains the same. As long as the structure remains the same, we are going to go to 2,750. One or the other. But first, we have to cross the hurdle of 2,600. Remember, it's not just numbers, it's the structures. So if you look at this downtrend line here, that's at 2,700. Sorry, that's 2,800 I'm looking at. Okay, so what's this downtrend line? The downtrend line is 2620. Let's zoom in now. This downtrend line goes from the highs of 2018. So this is a major, major, major downtrend line. Right? That downtrend line is at 2627. So if we cross over 2627, you're going to see, just the way we see almost every other day, the mother of all short squeeze, short covering rally, which will blast the crap out of the perennial bears like the Soroses and the other peoples and Jim Chanos, who sits here and shorts every American company. I don't get these guys. And shorting Tesla and losing money like, it's like no one's business, but still thinks Tesla's going to go out of business. I just don't get these guys. I mean, like they have way too much money. That's the only problem. They got billions of dollars at their disposal and they keep on shorting and sticking to an ultimate short, which never works out time to time, yet will keep on pissing on U.S. companies. Great. So, and that's Jim Chanos, by the way. Never liked that guy, but not just because he's shorter. He's just so smug all the time, It's just like, get out of here. So this is it. Let's take a look at the daily. This is your daily chart. This is your daily chart. Remember, simple rule of the thumb. Let's keep it simple. Remember, like my dad always used to say, always learn the advanced stuff, but then try to make it simple in your brain, and then it's going to work. If you keep on trying to be like, oh, I'm going to watch this, I'm going to scan to see what stock is good. Yeah, good luck. Okay? There are friggin' thousands of stocks in the market. All you really need to do is trade 8 or 10 or 2 from each sector. Seriously. Okay? So if you complicate things a little bit too much, like some of our members do, then you're just going to be screwed. You can't keep on complicating things. Simplify it. So one of the, but know the advanced stuff. That's for sure. So people like my good friend Fish Eyes and Jack, they've gone through the ACSs and stuff. They understand the basics of what I'm saying, and they understand the complexity of some of the things I've shown them. And Jack is an ongoing student, so he's going to be seeing a lot more as we go through the classes. So the bottom line is that, but then you simplify it. So let's talk about the simple version here. The simple version is this. Chart patterns and candles. Okay, we get it. We understand. This was big. It's a bull flag. This was 28th, which was Friday, right? Friday. And this is where we are right now. This little. Let me make this bigger. So the first pattern completion we are saying is well. I'll show you something. It's pretty obvious. The dotted line. Remember, Fib 50%. Fibonacci 50% level, retracement level. Well, that's exactly where it is. It's at 2635, right at the cusp of where the big downtrend line is. And this is not the first time anyone's seeing this chart. I show this almost every day. This big pink magenta thumb is where 2018 started. And that is at 2676. In one day, do we go break even on 2018? I don't think so. Okay, God knows, who knows? So all I know is there's a major downtrend line, and that downtrend line is at 2655. The 50% Fibonacci retracement from the highs of 2000, and I hope some people can read the Fibonacci retracement. It's not rocket science, okay? This is your starting point. This is where you went down to, or this is your starting point, 0 fib, right? So 50% of this whole fallout for 2018, that number is 2636. Pretty close to the 2659, where this big downtrend line is. So, at least mathematically speaking, that's where the market wants to go. But first, it's got to take out this level here. Please write that down, which is exactly where we went to. These charts don't lie. These charts were drawn before things happened. Okay? This was the low, the climactic lows of February 6th and February 9th. Guess where we went to almost this Friday before I had to take off at a little before 3 p.m. Exactly there. Is it a revelation that we had a sell program that came in at the lows, these pivotal lows here? Because when that level broke, the dam broke, right? 1, 2, 3, 4. 4 days of incessant selling. 4 days where the United States of America, according to so many mom and pop investors and traders and some of our members, could never, ever lift its mighty head higher again. Well, that's not what the USA does. The USA is built on power and risk. And next day, it had a minor reversal, and then it showed the world what we can do. Because when we falter, for whatever reasons, economically, our financial markets falter, it makes the United States weaker. I hope everyone understands that. When Wall Street and forget Wall Street, our financial markets, Dow Jones, NASDAQ, Russell, Biotech Index, all these things falter. These bozos keep on coming up and screaming that they're going to go lower. It's all over. This is a debt-fueled economy that is going to completely blow up. They love talking that stuff. 20 years ago, they said our deficits would blow us out of the water. Okay, great. 20 years, the market's like gazillion points higher. So bottom line is that, what was I going to say? So basically, I just totally lost my chain of thought. So the key is that you're going to hear all that stuff, and then the charts are going to come into play. So when this broke and they said that's it, it's all over because it was a waterfall cascade. At least it wants to go and test that 25, 28 level. So what we could get that we could get by tomorrow, because at 30 more points, that means 180 to 200 points above where we open up, and this is where we are right now. Now, simple rule of thumb: follow the stows. That's it. Follow the stows. If the stows keep on pointing higher as they are, stick with it. One thing I did notice tonight is that the Kapak curve, which is a more of a longer directional bias curve, had gone below the 15 level, which is generally where it's turned from. It's normally turned from about 12 or 13, but it went negative 19. Talk about panic. Kapak never goes close to minus 20, and we almost went there. Guys, these are things, such extreme readings. I'll put out, like the Tom McClellan's article about the fact that we had, what we have gone through is so extreme, it's not even funny. This is all happening because of, in my opinion, some liquidation going on from Europe, from other parts of the world, and part of it is a political move to damage the markets. It's my opinion, because there's nothing really wrong with the market. And they use different reasons for it. And everyone has some blame to take. A couple of the tweets coming out of President Trump, absolutely ridiculous. Scared the crap out of the markets. We don't want that. And the Fed stuff and all that. So anyway, so the fact that let's look at the technicals here. So the fact that the Kapak is starting to turn is a really good sign, because when the Kapak starts to turn, you get vicious multi-day, multi-week rallies. But it's not a trading indicator. It's more of a directional bias indicator. This, ladies and gentlemen, I've said a zillion times, is the trading indicator. If this sticks to it, then up and down, candle after candle, the patterns get done. This is where, there, 2636. Write it down. Look at my charts. We'll probably get there. We'll probably get there sooner than later. Now, in between, if we don't, we have to keep on following the candle structure. Not every day is going to be a beautiful, fat, red, green candle. And during each day that it's a green candle, there's a lot of zigzags. This 1,000-point rally didn't happen in one straight line. It started, went up, then it kind of went back and forth, and then it went. This rally the next day, which was up another 200 points or whatever, didn't just, here's a green candle, let's say. You think it just starts here and then ends at 4 o'clock here? No, of course not. It goes up and down. It goes up and down. And that's why we had the 15 one-hour charts for more active traders. And for people who want to be more of a swing trader, like I said, as long as the uptrend's intact, you stick to that swing. But it's stomach churning during the day when you're down 600, up 600, yet the daily charts don't really change. It just keeps on flowing higher. You stick with the trade. Pattern symmetry. Every action has an equal and opposite reaction. Don't know if it's going to happen, but it's a pretty high probability that over the next 4 to 6 weeks, if not sooner, nowadays a lot sooner, it is going to happen. This is going to happen. Kiss the 50 fib, kiss the downtrend line, and then maybe a big fat sell-off. Next is your weekly. Now, this is a very critical chart because this is for longer term people who are looking at the market longer term. This is serious stuff here, because this candle on the weekly is really beautiful. But in order for this beauty to continue, this is a weekly chart, cuts out the 15-minute, the 1 hour, the daily, this is the weekly. What happened during the week? Well, what happened last week was absolutely fantastic. Even though you will hear so many commentators out there who will say, no, it wasn't anything great. We sold off at 3 p.m. on Friday. I said, okay, fine. When you hear guys like that, you just want to smack them one. All right? Just tight slap, like they say. This is what you need to look at. If this is expanding, and of course this is a weekly candle, right? So it's not going to show you the next week. Tomorrow, it'll take a week to form. But if we keep on seeing the weekly candle, which I'll show at the end of each week or during the week, continue, then again, we are looking at a 2600 print, which is this inverted megaphone. Then a downtrend line here. This is the uptrend line from 2016, February of 2016. This big fat green line. A retest of the underbelly of the green line to test to see if we are, because on the weekly chart, the bull market broke. Because here's your uptrend line, well, at least from 2016, and you lost it. for 2 weeks. First week, no one believed. And the second week, everyone's like, that's it. It's never going to happen. And then the third week, went up. So key is that if we can get above the downtrend line, which also happens to be at around 2650, 2660, right? Or 26, yeah, 20, let's call it 2660 to 2670. Then we are back above the downtrend line. There's not much to explain. Then we go to 2800. Now, these things will only happen on the backdrop of a stable and reasonably non-panicky earnings season that is about to commence. Okay? And even then, it'll be stock by stock, but I'm talking in general. And 2800 will be where the Battle of Normandy, all right? That's going to be like a fierce battle. Lots of casualties, because that's where the lots of casualties started. So it's pretty clear. Keep an eye on this. Nothing more to explain. Liking what we see here. A nice triple bottom. Stowe move higher. This type of volatility has not been seen in the U.S. markets ever within a matter of one year, to be honest with you. Look at this. If you weren't following Clueless trading and didn't understand or demystify the markets and at least try to trade this, you'd have no freaking clue what's happening in the markets. It's a fact. So for a few of the people who left us because, they just can't, they just can't do anything or whatever, not do anything, but they say, oh, well, I'm not trading it. And I tell members, okay, let's say you're not trading for a bit. Fine, that's fine. But why not stay connected with our service? Because nobody's going to explain the markets, demystify it, and slice it and dice it and explain it in very, very scientific as well as behavioral terms like we do here at Clueless Trading. That's worth a few dollars just to stay with us. That's my marketing pitch. It's a fact. So, nothing to see here other than the weekly looks pretty good. And barring any major unknown risk that we don't know about, tough to imagine another retest of 2300. But possible. Low probability, but possible. And for those, we have to keep an eye on the shorter term charts. Now, let's look at the big kahuna. My wife's like texting me like, hey, gotta help her with something big. And I'm like, she said, you were supposed to do a 15-minute session, webinar. I said, well, that's what happens to me, right? I have good people here, so it just opens up my mind, believe me, because I really wasn't in the mood to do a webinar tonight. And then seeing you guys in here, I mean that, okay? I just like my brain opened up. So thank you for attending. And of course, everyone else is going to hear it. So look at this monthly chart. Since 2009, when the S&P hit 660. This is the E-minis. That's why it shows 650, 790. Look at this chart, okay? Here's your uptrend line at 2354. So the bull market, in simplistic terms, is not broken. Actually, right uptrend line is here, around 2200 to 2200 to 2300. So believe it or not, it's hard to believe, right? That this multi-decade, well, 1 decade, not multi-decade, like overshooting here, because 10 years would be 2019, going into 2019 in 2 days, that the bull market, the U.S. financial bull market, is not broken till we break below 2200. It might seem just absolutely flabbergasting to so many people. You're saying 2200. We're at 2400, 2500. You're telling me we can fall another 300 points, or 200 points, which is roughly around another 2100 points, right? 300 points on the S&P or E-minis is roughly another 2000 points on the Dow. And I say to myself, one of the biggest lessons that I've learned in 2018, and I'm sure you guys agree with me, is that 2,000 point drops don't even faze us anymore. Do we get hit on it sometimes? Bad? Absolutely. Do we turn around and take full advantage of the big reflex bounces? Absolutely. But does it scare anybody that we could have a 2,000 point drop in the market? As much after everything that we've gone through? It's like going through the worst urban warfare, combat zone, like the most horrific things that our boys have suffered through in Iraq and Afghanistan and these places, right? And seen the worst. So we've seen the worst. What ugliness looks like. So it kind of gives you a sense of like, bring it on. Bring it on. Give me a 2,000 point drop. I'll catch a good portion of that or a good slice of that or using our standard SPY puts. But it doesn't happen in a straight line. We know that. But so this is what I'm getting at. I just want to just make it very clear that from here to here is another from here to where we are to here. No problem, Jack. Thank you for attending. All the best to your family. Happy New Year. So we would drop about 2,000 points, and that would be the real test of whether this decade-long bull market is still on or not. Now, let me just put it this way. From what it looks like, if you just want to use basic technicals, the bottom that we saw, the short-term bottom that we saw, which was here, right, which I had already shown on my chart, the lower Bollinger, the 2360 level, is not a real bottom. I don't know what real means anymore, but it doesn't look like a real bottom. Why? Because the Stows still haven't come back to the levels of 2009, which was a negative 0.131. We are still hovering around 29 on the RSI, on the stochastics. So if somebody asks me, what does this mean? It simply means, in English, that the real bottom, meaning the real substantial bottom, which will start a multi-year rally, should start from 2 to 3, from roughly 2,000 points lower or so from here. And by that time, this will crash all the way down here. Can this happen by the first quarter of 2019? Like I said, if the reasons persist, the Fed goes a little bit nutty on rates, and earnings warnings, and these companies really start to get scared. We have no improvement with the China trade situation. There's global trade wars going on. Flares, yeah, no problem. We will basically go down another 2 to 300,000 points. There's a longer term picture. And then the Stows will hit here. And once it hits here, that's when you want to plunk in the maximum amount of money and just leave it in there. And just leave it in there. And trade with a little, just scraps. Because those are the times you have multi-decade lows and you basically let the market just go. Because not a single soul on earth bought the market on March 9, 2009. Not a single soul. I was in Wall Street, as you know. All right? Somebody did. So bottom line is that that's where we are. So that's your longer term picture. This is still a very bloody, long. Yes, it's got a nice tail. That's a rally we're having. Unless we break out over. Remember, this was the acceleration channel that started back on, I should talk about this back on February of 2016. That acceleration channel broke on the month of December. That acceleration channel, if recaptured, the markets need to go up above 2,700. Once you're above 2,700, you are back in this channel. There. Once you're over 2,700. Let me see here. Yeah, like 2720, 2730. You can get specific, 2730. But you would be back to the structure. But for now, we just got to trade the ranges, everything I've explained. This is your monthly chart. Once we start to see this bottoming, my gut tells me, and this is my opinion, what happened in 2009 was completely a different story. That was a complete credit meltdown. Thanks to the whole mortgage mess and all the CMOs and CDOs and all these different derivative products related to the U.S. housing market completely blew up. It was a global situation, global recession. Okay? That's not the case now. Okay? And President Trump is doing a phenomenal job on the business side, and he needs to basically just keep things at check, not go overboard on certain things, keep on talking, keep on doing things. He gets things done. And we're not going to reach this generational lows on the stochastics. What most probably is going to happen is the same thing that happened in 2011, right there, September 2011, September 2015, and now this. Once you engage this also happened in 2016, close to it, not there, which was on January of 2016. So coming down to it, I believe that this red line here drawn for everyone's attention is where we are going to get close to. And once we start to see a slight tick up, that's when the market does jumping jack flashes and we are back into the zone. And if we start to tick up like this, trust me, we're going to make a new high in the market. That's going to go to 3,200 S&P, and nobody's going to believe it. But we're saying here first that if we follow these charts and we keep on keeping an eye on it, whatever the noise is out there, and I've explained the major factors that are going to drive the market going into the first part of 2019, their markets could hit a new high. And remember, the level of despair, the level of absolute terrifying fear among fund managers, among hedge funds, the hardcore dogmatic shorts, the Soroses of the world, completely pissing on the U.S. financial markets is a great ingredient for a multi-month rally as long as the factors that we spoke about fall into place. And by the time it gets there, it's too late. So these are the times we need to keep an eye on it. I think the bottom that we saw short term has been put in place. The multi-month, multi-year bottom maybe has not been put in place. That's about another 2,000 to 3,000 points lower. And if it gets there, well, when it gets there, we'll talk about it, but I explained that. So on that note, I do have to run. God bless you all. And I will connect back with you guys right after the new year. And please pray for us that we can hopefully fill the gap that we have with our little doggy going away. I know it's for some people who are not dog lovers or don't have pets, don't quite understand, but it's like losing a piece of your soul. It's like losing a member of your family. It's exactly the same feeling. And thank you for everything. So Happy New Year, everyone. I will be absolutely. Thank you, Jimbo. Thank you. And give your pooches a big hug. And 2019 is the year. It's a year where we just have to 110% not believe anything we see, but try to follow the charts as much as possible. I will keep on doing what I'm doing. God bless you all. See you guys tomorrow. Thank you.